Hi, good afternoon, everybody. Welcome to today's session of IMPunjab's Masterclass. Today we have Vamsi Bhogi from Let's Venture to take us through the fundamentals of fundraising. Throughout the session, we will be breaking a few myths about what stages your funds and throughout your startup journey, fundraising is required, and so on and so forth. I will let him take this further. But before that, a quick introduction about our star speaker today. Someone who started this as young and with varied experience, there's a lot more for you to learn. So Vamsi is the head of Startup Curation at Let's Venture. Let's Venture Company is a unified technology platform for equity management and growth stage transactions, and also helps in raising funds. Interestingly, he started his journey very early in life when he was investing in stock market at the age of 16, and eventually by the age of 17 he was also providing real estate services, and he had his own marketing agency by the age of 18. He's also been very proactive in providing as a being a digital mentor for the Association of Chennai Real Estate Agents Association. With this, he's experimented with 100 pieces of content strategies that has been successful in terms of meeting clients' digital marketing requirements. Interestingly, we also feel one of the most essential skills that may help your brand grow is fundraising. Um, and with this session, we will have Mamsi kind of decode what really is required in terms of fundraising, from investing in stock market to providing services, and to how to scale your startup. Over to you, Vamsi, and a little bit of introduction about just before we start for all of you who have joined for the first time. So Innovation Mission Punjab is a public-private partnership. We are set up to stir the entrepreneurial ecosystem in Punjab. Having said that, these masterclasses are open across for the audiences beyond Punjab as well, and we look forward to collaborating with you and strengthening the ecosystem. Thank you.
Thank you, Supriya. Thank you so much for the intro.
In case I missed out on anything, please, the audience would love to know more about you. This
No.
is, I think, among all the things you do, this is just a quick introduction and brief. We'd love to know a little about you as
Yeah.
well.
No, thanks for mentioning what I think almost everything was already covered. So, but just to add on, so as I mentioned, so as Supriya mentioned, so basically I head the startup sourcing and curation team at Let's Venture. So Let's Venture is a platform where any startup that wishes to raise funds at an early stage come over and basically go through the basic evaluation process, and which are basically goes through the evaluation process and comes out, is usually hosted on the platform, and where it is shared with all the angel investors that are there on the platform, which are almost like 12,000 angel investors. They get to look at your startup, and whoever are interested usually go and fund your company. So fortunately, just to give a brief intro on in terms of how the funding market has been moving, first of all. So if you take from the last 5 years, there had been a significant growth in terms of how startups have been uh, able to raise funds and how comfortably they were able to do it. Because prior that, there were not many channels, or there were not many platforms that startups could go towards, or startups could really pitch to. There were only venture capitalists, and reaching to venture capital level is a very difficult game, because you need to have a lot of growth story or traction to be built prior that before you go to a venture capital. Now, what I'm going to do is I'm going to walk each of you through, first of all, what happens, what are the funding ecosystem look like, and then how do you even take first steps to finding your first angel, etc., and what are all the things that you have to cover when you are actually like talking to an angel investor, and or this is a specific VC, etc., or a micro VC. And then couple of startups that I have worked with or I funded personally, and what were the kind of parameters we looked there overall. So these are like few blocks of information that we'll be covering throughout. So let me just share my screen. So hope everyone can see my screen.
Yes.
Yeah. So the startup funding basically happens in several stages. So anyone who is not aware, I'm just for their benefit, I'm just mentioning maybe some ground level stuff. Where, for example, if some, I'll just give you some basic examples, right? So there was a friend who started an edutech company, So when this friend started the edutech company, it was more of a one-to-one live tutoring, where, for example, if I'm studying for my 10th class exam and I have a doubt in my maths test, then I can basically take photo of that specific problem and mention it on a WhatsApp group of theirs. And what they did is they used to connect to a tutor manually and make sure that the tutor was solving my problem on a live video. Now, this one is a very scrappy model where they basically started with WhatsApp groups. Now, what they did is, like, with that WhatsApp group itself, they were able to build like 1,000 student base. Now, since they had 1,000 student base where it was working out, they took this model and showed it to investors. When I say investors, I'm talking about angel investors. They told them, saying that, see, this model is working, why don't you invest in our company where we could make it more better. Now that is where it is almost like a seed stage, where you are just taking one basic model that is able to work and you are able to show it to investor, and that is called seed stage or pre-seed, where the investors are willing to bet on your basic proof of concept. So proof of concept is nothing but the 1,000 students working it comfortably or where it is working out. So they were basically able to work it on a seed stage. Now, assuming that the 1,000 students grew to 1 lakh or 2 lakh students, it can go to a early stage funding. Or there is also something called pre-series A, which they do before series A. But it's almost like where the round of funding also is also increasing. If at all someone has required only $1 million funding, like almost like 7 crore funding at early stage, they can do maybe like 3 million, 4 million sort of thing in the series A. And whenever they see further growth, maybe from 1 lakh they went to 6 to 7 lakhs, they will go for a series B. And once they go to maybe like 40-50 lakh students, they will go to series B or series C. So in that way, with every step of funding, they are expected to grow exponentially. Until series C, if you are gone, people like you're a very phenomenal growth company, and all these series A to series C or beyond, usually the venture capitalists are the ones who are the ones who basically enter into the game and who help you to raise higher amount of capital and help you to raise and grow faster. Considering a normal company to a startup in general is where your startup is expected to grow very fast. In the sense, for example, if you take companies that were initiated quite few years back, like for example, let's take a restaurant as an example, and restaurant as a startup as an example, you can say. So usually we would have seen like there would be chain of restaurants which would have grown 50 branches, 100 branches within the scope of 20-30 years, which is a very high growth. But consider a restaurant growing 50 to 100 outlets within just 2 to 3 years. You're obviously like 10 times faster than a traditional brand. Now this is where the funding aspect comes into the picture. People who are believing in the founder for very high growth are investing into that company and are ensuring that they are supporting them in all the ways possible. And that is where the investors are interested to invest in their money, because that is where they are able to see multiple return over there. So that is how this entire arena of startup funding usually works with the angel investors, and also like other investors, and also the venture capitalists. So uh, so this is how it is slightly more elaborate thing. The letters might be small, but I just read out in terms of what is written here. So average range and also the typical company valuation. So since what happens is most of the usual funding happens in dollars, or they are usually pronounced in dollars, you can say. So as I mentioned, pre-seed. So pre-seed are someone where it's almost like a seed round where the investors, friends and family. So friends and family are something that are most undervalued set of investors, but at the same time are very important investors. If at all you are able to raise money. See, most of the startups, what they do is they directly try to jump into the angel investors. But I don't think for everyone has the luxury to do that, because it's very difficult to attract an investor who is completely unknown to you, first of all, and you're expecting them to give you money. Now, what you can also do is, if at all you're starting your first company, you can just ask your friends and family to first fund it, because you might not have all the funds that you require, and give them a small percentage of your company. And then after that, you can treat it as a pre-seed, which is less than 7 crore. And then you can move to the seed round as well over here. And then on the other hand, you can have very early stage angels also. And also there are a lot of startup accelerators and incubators that are there. Even Punjab has a lot of accelerators and incubators that government is trying to support. So you can go to any of them, you can pitch them saying that this is what you want to do. They will try to help you as much as possible. And this is again like when I say pre-product, is more like a scrappy product that you're trying to build, or you're just trying to showcase this is the concept of it and why you are capable enough to do it overall. And also,
Vamsi, just a suggestion. Could you just zoom into this side a bit?
is it visible?
Yeah, much better. Thank you so much.
Yeah, thanks for mentioning. So again, when they are giving you the pre-seed sort of funding, the majority of the funding happens based on the team members, because you do not have much to show. You can only show like what is your credentials and what you can do and what are you capable enough to build it to that level or not. So as I mentioned, it is more like the prototype. It is like going back to the example of where my friend wanted to do a one-to-one tutoring, and they just had a WhatsApp group to show. So when they tried taking that WhatsApp group as a reference or the benchmark of how things will look like when it scaled up to maybe 40,000 students or 50,000 students. So based on that, they got their money of $1 million. Now coming back to the seed funding. So seed funding is something where you are able to build some scrappy product, some basic level product, and where there are early stage VCs also interested, accelerators interested, but you can see majorly the angel investors are the ones who will be more the right fit for this type of investment. When I say angels, what happens is, if at all you want to raise $1 million, not one angel can give you that money. There are multiple angels who club together, who come together, put in like based on their capacity. Some might put 10 lakhs, some might put 20 lakhs, some might put 30 lakhs. And there might be someone who might be putting only 5 to 10 lakhs. So based on all these things, you will be basically taking all this money, club it together. And what happens, the issue is that point of time when you have lesser amounts of money, you face the risk of giving individual contribution or individual seat on the cap table. So cap table is nothing but who are owning the shares in your company. So when you have multiple people owning shares and you have multiple people having a space in your company on your document, it is difficult to manage everyone. You can say like Supriya is one of my shareholder because she gave me 10 lakhs. Dhaval is my shareholder because he gave me some 20 lakhs. But it is difficult for me to manage everyone at the same time, and many of you might give some more amount. So it becomes difficult for me to manage. So one option that can be done is where you club all of them under one platform. So that's where even platforms like Let's Venture play a role, where they basically club everyone together and they have one individual entity on the cap table. So that's where having angels and at the same time a platform will help you in general overall. And signs of product market fit. So signs of product market fit is nothing but just trying to show some traction overall. You trying to show some traction, saying that this model is workable. This model has shown its power in terms of the consumers, and it's also able to show some impact across the consumers is something that you're able to show overall. And when you know that you can directly show you're able to create an impact across the people you're working with or the customers you're working for, the money that is required is basically to make it better, to reach higher number of audience, to be having the ability to basically start working on a revenue model overall. So this is where you need to start pitching, and this is where this is what becomes attractive to the investors first of all. And funds, again, product development. So as I mentioned, the funds are usually used for the product to make it better as I'm overall. Any doubts till now?
There is a question which has come up. Ideally, how much should a startup dilute during pre-seed or seed stage? Your comments on that?
Yeah. So usually it is 10 to 15%. People do even lesser when it's pre-seed, when they do it with friends and family. With friends and family, when they do, they basically do it like 5 to 10%. But whenever it's an angel that is entering into the seed round, it is 10 to 15% in general that they dilute.
And how the valuation is done during pre-seed phase?
See, usually what happens is you can either get a valuation, a person who does valuations that are there in the market to do it for you. Because what happens is, based on the pre-product, if you are a pre-product and if you are a if you're already having an early traction, a lot of things change, and it's a very complex subject where uh, someone's word might be coming into agreement, someone's word might not come into agreement. So for that to avoid, usually people do valuations. People usually hire CAs to basically do the valuation to be done, and based on the instrument that they're choosing, whether it is a safe note, whether it is a, when it is something called safe note, it is where the valuation is just kept somewhere in the air, saying that this is the valuation we are all agreeing on mutually, and they try to do the transaction based on that valuation that way.
Also, if I may ask, what is the duration of this stage? Like, at what stage of a startup journey would this be relevant?
So you're talking about the pre-seed or seed valuation, Supriya?
Yeah, yeah.
So as I mentioned, just going back to the example of edtech company that I gave you, right? So when they started off with their prototype of just a WhatsApp group, so they just started off with a WhatsApp group, hit 1,000 students number on that WhatsApp group, and then they were able to crack the pre-seed of $1 million just with some good contacts. But because they had a very good marketing team that was able to market it, it is not necessary that everyone does the same. There are people who just raise 60 lakhs, 70 lakhs as pre-seed, and there were people who basically like raised 3.54 as seed round overall. So when it comes, so the difference between pre-seed and seed is, in pre-seed you are able to just show the team, you don't have anything else. Maybe you are more like just a team that people are believing and putting in money. When it comes to seed, you are almost somewhere near the product, either the product is being developed or the product, for the product building, or for the product streamlining or making it fine tuning, people are actually taking the money.
Any last bit in terms of, is the time duration open? That means it could be 6 months to near to 2 years. What is your say on it? It could be different for every.
Yeah, it can be very different from for everyone actually, because I have seen companies that have actually had the capacity where they have put in their personal funds, they have run it for very long, and they build something substantial, and they directly go to series A. They don't they skip the pre-seed and seed round in general. There are like companies which basically run for 7-8 years, and they pivot their entire business model, and they just, for building a better product, they'll take seed round. So it is a very subjective matter, but if you ask me, in general, the very standard procedure, people take 6 to 8 months to basically build their entire product market fit, and they basically like either they can raise pre-seed or seed round, and then after raising the seed or pre-seed, they basically work for like 8 to 12 months, and then they go for maybe a pre-series A round or else a series A round. But I'm talking very optimistical way, but that is how usually it moves in general. I hope, please let me know in case if I was able to answer your question.
Oh, yes. Thank you. No, just that much only, because a lot of startups do have a question at what stage, at what time, because this could be varied for every journey or every
It
startup.
varies
So,
for every journey. It varies for every journey, but we can pick up a couple of questions maybe in the end where they can let us know their concerns, so that maybe we can get into certain depth as well. That works.
sure. So we'll proceed. There are a few more questions, but we'll take it up in the next session. So we can start.
Yeah, yeah. So and also series A. So series A is again like a very early growth stage sort of metric that is taken into the consideration, where as I mentioned, you have certain revenue model, you have you have basically, for example, just going back to the similar example, the company has taken from 1,000 to 10,000 or 40,000 students in the seed round. Now they want to make 40,000 students to maybe 4 lakhs from the tech company example. Now they want to make 40,000 to 4 lakh or 5 lakh students. That is where the series A is coming into the picture overall. Now so that's where they are seeing like maybe super angels. So super angels is someone who basically invested in some 20, 30 startups already, and they have got some very nice exits where they have helped the companies to grow fast, etc. So in India, we have like a lot of people like Kunal Shah is a super angel. You can take even Vivek Khare, who has been invested in Zomato as one super angel, and there is someone called Govind Swaryawala who is a super angel. So there are all super angels overall. who basically are helping startups very closely. And venture capitalists, as I mentioned, are the organizations with huge amounts of money with them, like 100 million, $200 million funding in their kitty, which they have dedicated to invest in startups overall. And revenue growth, right? So as I mentioned, maybe this, when they are doing like a 10x 20x jump, that point of time they want to ensure that there is a revenue growth. Excuse me. And marketing becomes increasingly important, right? So that, because I'm talking about growth here, that's where the marketing, most of the budgets usually go to marketing over here, and trying to create a new sales teams and also marketing processes overall. And understanding ideal customer is subjective, which happens throughout the process overall, where they try to expand the business and everything. And series B and series C beyond, what happens is you have some more bigger VCs or even sometimes private equity firms get into the picture. Now here the scaling becomes even more phenomenal. So for example, we are talking about 4 to 5 lakh students here. Now this 5 to 5 lakh, it might become, we are looking at a jump of 50 lakhs to 1 crore type of student. That means you're looking at a very massive scale. So that is where that is the kind of funds, or that is the kind of money you're looking for here, and you are seeing that. And you are going to hire some more professional team. Till then you might be managing with a smaller team. Till then you might be like just working with few, 1 or 2 professionals that you know. But here, when you are getting like very expensive hires who can do a lot of works for you, expanding into new markets. Now till now these people might be just focusing on just first to 12th class. Now they might even expand to like government exams, they might expand to IIT JEE coaching in specific, and they are trying to capture more and more market, so that they want more revenue coming into the picture, so that the water investment that is happening, the investment is basically someday finding its returns overall. So that is where you're.
Vamsi, I think I just wanted to touch upon this interesting fact you just mentioned, and if you can detail that out, is how the team strength varies from when you're moving series as well. Like when you mentioned that there would be only founding members initially, and then when you're moving and raising more, you will need professional help. Could you kind of detail that out towards once you're done with this series as well?
I just come to it. I'll just come to it. Yeah.
Sure,
So as
thanks.
I was mentioning, I think I'm just done with this. So as I was mentioning, this is where the entire trying to fuel the revenue, trying to fuel the hires keeps happening. Now coming back to the team aspects and the team size, right? Now, for example, you take pre-seed might have just the founders and couple of execution team, but most of the founding teams might not even have that as well, because maybe founders might not have enough budgets to employ someone, but they might be the only one within the team. Now coming to seed, they might have people, right? They might have people coming in, they might have 10 people, like, or some teams are fortunate enough that they have 20-30 people working there now. But when it comes to series A, it is very subjective, because depending upon the industry that you are there in, because there are companies that are into software who are able to manage 30-40 people. But on the other hand, you have some operational heavy businesses. For example, maybe you are renting out, for example, furniture, which is a bit operation heavy, where you have people, but obviously your per person hiring cost is less. Maybe for, even if you take Zepto needs more people, because only then it will work, because they can only work it out across the nation. So for them, they might need maybe like hundreds of people. But companies like, maybe like an edtech company, again, because I don't want to deviate from the example, so that it's throughout the session, there's a base that they can stick to. Maybe that company might have some 60-70 people, series A. But when they jump to series B, obviously we are looking for a 10x 20x or 50x sort of growth overall. That's when it might go to some 200, 300, or even 400, we never know. And beyond here, like, there might even be thousands of employees. Like, for example, there is an academy, there is Zomato, there is Byju's, and all these people have thousands of employees. So this creates a massive growth. That's where even your employees count goes exponentially throughout this entire growth curve, that way. So as I mentioned, so when you are getting into the venture capital segment, you have a lot of uh, what do we say, lot of relative ease, because you're trying to convince only 1 or 2 entities to invest in you, first of all. And there are also people who have experience in different segments that are trying to help you out and trying to fund you, etc. So you are going to, and also at the same time, it is very difficult to convince a venture capital to fund into you. And because they are trying to focus on how big is the exit going to be, you should be, they will only trust you and they'll give you money only when they know that you can give them a 50 to 100x type of return, first of all. Only then they are going to believe you, or else that you might not be a right bet for them, because they have to deploy that heavy amount of capital into someone who can make it bigger overall. And their terms are very aggressive. As I mentioned, 50 to 100x type of numbers are very, very aggressive numbers. If you don't try to give those numbers to them, they're not very interested in you anymore, right? That is what they're expecting. The exponential growth is what their expectations are every time. And near term exit is primary goal. So that's what, right? Like if you are doing like there are startups who do early stage VC, there are startups who do growth stage venture capital as well, who growth stage funding as well. So based on the kind of fund they are in, some funds might be just maybe $30 million, $50 million, $100 million. There are other funds like Sequoia Capital who are like $1 billion bigger, right? So who are $1 billion and they're like much more bigger than 10 times bigger than a early stage VC. So that point of time, these people they basically might not expect immediate exits as well. So depending upon the stage they are entering, it might vary from company to company. And then you have family offices. Family offices are again like type a hybrid of venture capital and also an angel investor, where the relationships are more friendly compared to a venture capital in terms of the kind of terms and conditions is what I mean. And where they also have like cash, which is somewhere in between angel investor and also a venture capital. Somewhere in between you can position them, these people. And usually these people will be just interested or investing in maybe a series A, pre-series B, pre-series A type of rounds most of the times, because that's where they feel that as a soft spot or a comfort spot for them to enter into the game right now. So again, as I mentioned, this is more like a casualness on of an angel, but also like the no, bigger. When I said bigger, let me put some sense to it. When I said bigger, what I exactly mean is, for example, someone needs a $2 million funding. For a family office to give 500K is not a very difficult amount. But somewhere going the entire $2 million is not a easy amount as well for them. So that is where they position themselves most of the times. I'm talking about very generic positioning from family office to family office. It might vary. There might be family office of bigger uh, people who might have the ability to even fund $5 million as well. But I'm not talking about everyone. I'm talking about in general, generic manner as well right now. So
Could you share an example of a family office setup
I was
for
mentioning,
the
right?
audience?
Maybe like a Bajaj group
Godrej.
has a family
Yeah.
office. Godrej group has a family office. It may be
And
Reliance.
any particular startup they must be investing in, just to put in perspective that
Right.
the
So
audience.
for example, even Deepika Padukone is there, right? Deepika Padukone has a family office. She's a high net worth individual, and her father is a badminton player. So they have a family office that invests in startups where they might do 500K types of amounts right now. And most of the actors right now are setting up their family offices, right? So Deepika Padukone has invested in this fan company called Atomberg right now, and there is Sanjeev Bikhchandani who has invested in Burger King. So there are these types of bigger people, high net worth individuals from their family have been investing right now.
Interestingly, you touched upon the topic of celebrities and investment.
Yeah.
There are quite a few of them which are coming forward. Be it, if you could kind of share what kind of investment that would be. For example, Anushka Sharma going in for Slurp Farm. Vis-a-vis, there are a lot of them who are going into vegan. I mean, this is just a food category which I'm mentioning,
Right.
but there are so many others which probably do not have the glam quotient to come forward. But there is a lot happening in that space as well. Would you like to share a few examples with the audience?
Yeah, right now, if you take Shraddha Kapoor has invested in this beverage brand. I'm not able to recollect the name immediately. It's called Soon, I think. Soon, which is a zero sugar, zero calorie drink, right? And even Varun Dhawan has invested in this protein powder company. I don't remember the names correctly, but He has invested in the protein powder company, and Shilpa Shetty has got her own fitness app. Now, in this manner, most of the investments, at least I personally saw, were something were something that were resonating with their personal life most of the time, and that's how these investments, at least we have seen, were happening. And most of the times, how these interactions happen is they majorly try to promote from the fund, not just the funding standpoint, but also the promotional standpoint. They try to say that our brand value is so much, we will give money to an extent, but also promote the brand more, right? Because they want to make use of their stardom, first of all.
That's how they become brand ambassadors. The
Yeah.
value they bring to the table is being brand ambassadors and having a face to it.
So soon he has Shraddha Kapoor as brand ambassador, and Shilpa Shetty is her. I mean, like she works with whatever brand she works with. She's brand ambassador, and Epigamia has Deepika Padukone as brand ambassador. And I think you can see it. There are other brands which I'm not able to recollect right away, but there are
Sure.
brands where there is this company called Sustain Card. So Sustain Card has got multiple actresses involved in them as a brand ambassador and also the investor right now. So Samantha, whoever doesn't know, whoever are from North, Samantha is an actor who from the Family Man season 2. So she has invested in this
Yeah.
company called Sustain Card, right? So she has also been like a brand ambassador for that company overall. So even though there is an actress called Keerthi Suresh who has invested in Sustain Card. So depending upon how who the actress or actors are, they try to pull them into the picture. They try to make them the brand ambassadors. So it helps them both in terms of brands and also this way. That's why. And Virat Kohli has invested in multiple brands.
Definitely, I'm sure. I'm going back to a question which says, in scrutinizing the startups, does investors ask for patent before investing?
Patent, right?
Yeah.
Patent is again subjective based on the company. Like whenever you're talking about engineering majorly, that's where the patent really comes into the picture most of the times. For example, if there is a company which is a drone company where they were having patents on the kind of movement of the drone, they were having the patents on how the engineering of the drone is done. And there are companies which are into brain technology or brain relevant technology where they are having patents on how the signals of the brain are basically being transmitted. And usually the patent has a value only when the patent is granted. You applying for the patent doesn't really grab the investor's attention so much. Only when there is a patent that is available, that makes really very attractive. And also what patent it is it like a US patent or is it like a just an Indian patent? Because US patent has a very significant value compared to a normal patent across the globe, because the terms and conditions that are associated with it or having connection with it are very what do we say, are very strict. That would be the right word, is what I can say. Yeah.
Okay. If we can take another question, Vamsi, it says it's about breaking the myth in a way, but if you can kind of streamline on this, how true is that investors do not like to invest in service-based startups? This is a question by one of the startup founders.
It I mean,
Is there any, sorry,
go on.
please state.
No, go on, please finish. Yeah.
So the question is there any preference of investors in certain kind of sectors, etc., that may vary across VCs and angel investors?
See, service-based companies, I wouldn't say it is not attractive, but at the same time, the reason, see, if you take urban club or urban company, is basically service-based company, right? You maybe the positioning they might say is a different thing, but at the end of the day, what urban company does is it whatever home requirements I have, it is going to come and take care of it, right? It's a service-based thing. The reason why it is a bit not as attractive as other businesses, or maybe that might be I don't think that would be a right statement to say it is, if at all the founder is having the ability to distinguish or are able to standardize those services. I think nothing like that, because what most of the investors see as a concern is the founder able to stabilize, or is the founder able to streamline those operations in a way where it is always the same? If I'm expecting an urban club company or urban company guy come and clean my house, someone might clean it in a very very nice way. Someone might clean it in a like just like that. It just like just the basic way they might clean. Now I'm not getting the same type of service every time I call them, right? So that becomes a concern. Number one. Number two, it is more like you, if until the company is too big, if you are very in a very very initial stage, there are several competitors that you are having until you become too big, right? So there are a lot of parameters that have to be taken care, or there are a lot of duplicacy that has to be taken care, right? Because by the time you grow, if there are other people also doing the very similar service, for you to grow is a very very difficult thing, right? So this is where actually becomes a concern. And you don't have a patent, anyone can come and do the service. That's how it is a difficult thing. So if at all you are able to provide a service, why only you can provide, why not anyone else can provide? That becomes a critical thing that you should be able to answer to your investor. Any other questions?
There is one question which says, is there, if some family business wishes to start a family office, how can they start? So, for example, the particular person is from Rajkot, which has a large number of family businesses. So,
Right.
how do they get into the family office business?
They want to start a family office or they want to go to a family office?
They want to start a family office.
Okay. See, one thing is, either if someone in the family who wants to actually initiate it has the knowledge of startups also, they can do it on their own, where the specific person can manage it and they can have a LLP or something created, so that, and also allocate some funds on that thing. Every year they will be like, maybe every year we will invest some 10 crore, for example. That will be the budget they'll be setting it aside onto the startups. So they'll be like every, and they will just they'll just try to, they should be trying to socialize with startup founders as much as possible, to be around the startup, so that they can get exposed to the startups consistently, and whenever the right startup comes into their picture, they'll invest in them.
Also, does location play a role in it? For example, someone is based out of Rajkot, as they mentioned, and a startup is potentially based out of Mumbai, or Ahmedabad could be closer home. Uh, would
I mean,
location play as a
see,
factor?
location, being at the location always helps. No negotiation on that. It always helps. But at the same time, if at all you are popular enough, then obviously people reach out to you personally. And at least, if not physically, at least if your virtual presence is more right now. For example, you're posting consistently on LinkedIn. Your it's startup interactions on LinkedIn. You're at least taking effort to talk to the founders every day on LinkedIn, or reaching out to them. So all these things really make an impact, right? But obviously, when you are in Bangalore or Mumbai or Delhi, talking to the startups directly, more directly or more reachable, it really makes a lot of difference again. That obviously every one of us know, it makes a lot of difference being directly in touch with the startups or the specific founders also. It really makes a difference. But on coming back to the question, people either they can do it on their own, or else they can hire someone who can uh, who can invest on behalf of them. When I say invest on behalf of them, what I exactly mean is, if for example they have a manager or someone who they know that is associated with startups a bit strongly, and they will be like, you bring the startups to us and we'll choose the startups from them and we'll invest. So there are these type of interactions as well that keep happening. And someone who is starting off at a very beginning level, or someone, I would recommend them to have be in touch with someone who is interacting with the startups a lot, as their maybe consulting manager, or else a manager who can work with them, and so that they can, it will help them a bit more easier. Because getting into the startup circle, startup funding circle, is more like getting to those cream startups which no one else has access to, or which getting early access is the most important thing in general, that way.
Thanks, Vamsi. A reverse question: how can we approach family houses to get investment from them? Just a brief. information on this?
Usually what happens is like when so for example there is Let's Venture sister company called Trika. So Trika usually deals with family offices throughout the country. When either you deal with these people whom you deal with these networks who basically have access to these family offices or who can introduce you to multiple family offices in one shot, or else you can usually also get an investment banker who has connections with multiple family offices is one more easy thing to do. On the other hand, you just go back to, if you go to LinkedIn and search family office and all, you will actually find a lot of them actually that way.
Of course, personal connects definitely help, along with a little bit of networking across
Yeah,
platforms, is what
yeah,
you
right.
suggest.
Exactly, yeah.
Okay. We may move on from this, Vamsi. Thank you so much.
Yeah. So as I mentioned, for you to find investors, as I mentioned, LinkedIn, Let's Venture is one way you can find investors. LinkedIn as a one more way, you can just type the word angel investor and you will see like people reigning with the tag angel investor actually. And even Crunchbase is place where you can actually go see who people, what kind of investors were invest in what type of companies, right? That again will give you some understanding on, okay, this is the kind of company and these are the kind of people that are investing. So you can maybe reach out to them saying that we are also a very similar company, do you recommend anyone, do you want to invest in us? So all these things keep coming up based on the platforms that you are able to utilize at this moment, that way. But LinkedIn is a very powerful source when you want to do your very search on your own. On the other hand, Let's Venture, since obviously have seen the power of platform throughout the months that I've been with the platform, I think that has really been a very powerful tool, because even last year Let's Venture has been part of 300 startup funding till now. So I personally saw the power of startup funding that was happening through the platform in general, that way. Even if not even me being outside the organization, I would have mentioned the same thing, that way. And Crunchbase is always one good source of place where you can go and study about the investments that have happened till now, right? So before I jump in, any other questions that you want me to answer, Priya?
Question which says, what kind of investors should be targeted for a business, a B2G business? So are investors really interested in a government-based setup? One of the myths is that government is a difficult client, but a big spender. It also acts as a negative element for investors. Is that true?
So government businesses is attractive business, or is the still question there?
Yes, yes.
Okay, go on, please go on. Yeah.
That's the question. That is the question, that government businesses, how do we get investors keen on it? Is it it's a big spender, but it also has a negative element
Yeah,
attached to it. Would you like to share your thoughts on that?
yeah. So this question, right? So government, you having government clientele is a very very attractive thing, because you know that your money is coming, though it is a bit delay. You know that money is going to come. Number one, and also you mentioned like the contract orders might be slightly bigger, so that is also an attractive thing. On the other hand, you should be able to demonstrate your business, saying that beyond government I can grow. Beyond government, I still have the applications that people are wanting to be part of, or people are wanting to use, right? So for example, there is a company which was doing 3D printing of 3D printing of houses or staying structures, right? Structures where you can actually like live. Now they were building these bunkers for Indian Army right now using 3D printing. Now I know that though government is the current major clientele, going forward, I know that even builders can use that, even developers can use that, right? So when I know that there's an external application that is possible just beyond the things whatever are there, that definitely is an attractive option. You should be able to demonstrate the quality or the implementation out of the business. Right now, even if you take a lot of medical device products that are out there, there are hemoglobin testing machines, there are sugar testing machines, which have heavy government orders, and there are actually companies which are having the demonstrable capability beyond the government orders, right? They are like, there are a lot of customers buying them. So that makes it more interesting to the investors, because if you stick only with the government, your orders might it might be very, very nice in terms of order books and everything, but since they want you to scale faster, scale bigger, you should be able to see beyond the government thing that way.
Thanks, Vamsi. We can kind of discuss. This looks like a very interesting slide on. I think everyone's clued on what these 10 points would be.
Yeah. So this is more of just getting in touch with the right investors, right? So you basically, you know that like plan to contact a lot of investors, right? So you should be able to first of all start talking to the investors. As I mentioned, you can just go to the LinkedIn, get on to Let's Venture, say that I want to start interacting with the investors. You basically start talking to investors. You start building relationship with investors. So this is like a blueprint which any one of you can start working on if you did not have any prior interactions with any of the investors. So you can just go on LinkedIn, type angel investor, you start like finding people, you just go send the invite, tell them I'm interested to talk to you, this is my so and so business. Start building relationship with them, like telling them, saying that this is what I have done, this is what I want to do, what do you think I should be doing. So you have to always having that relationship would help you a lot. Now one more thing you always have to take care is investor circle or the VC circle is a very, very small circle. Like if someone gets to know you, there is the word spreads very easily. Like for example, there is a startup founder that messes up with anyone for whatsoever reason. It the word spreads out very fast usually. And also you have to get your pitch done, and also you have to make sure that whenever you pitch someone, there will be a lot of times where you will not be able to get a reward immediately because they might be held with a lot of things. So you have to make sure that you're following up with the angel investors, you're following up with the VCs that you have interacted with, because they might have several other works, but you have to always make a point to follow up with them in general. And also, see, right now me saying that if coming back to the one-to-one live tutoring example, now this person saying that I have built 4 lakh students till now, but going forward I want to create a service that is basically able to handle 1 crore students, is very different from saying that I have basically I'm serving 4 lakh students. Out of 4 lakh students, 3.5 lakh students are actively taking my services. So I am very confident saying that I can scale it up faster, because one time you're showing vision, one time you're showing what is possible. On like for example, you had the story of or one liner saying that Bill Gates was mentioning, saying that on one day there will be in every home there will be a computer, right? So that was a vision driven statement. Now you know that the moment he or she talks about vision, you know that that person is basically talking about very, very aggressive growth in the next 10 years or so. On the other hand, when you're talking about the metrics, when your metrics are super good, you know that the metrics will act as a foundation for saying that okay, this startup founder can really bring in whatever he's saying, he can pull it off whatever he or she is proclaiming right now. So that's where the focus and the big vision thing comes in. And also always make sure that you are, because there are people who have faced difficulty with investors because investors wanted certain activities to happen and the founders were not very much comfortable doing them. So it is always better that you spend enough time with the founder, sorry, the investor, and also get an expectation from the investor in terms of what is their expectation in the long run, so that there are no conflict in the visions of the company, how it is supposed to look like, first of all. And on the other hand, you as a founder, your one of your responsibilities raising money, but raising money is not your day-to-day job. Once you raise money, you have to go back to the business, start working on it, and see how you can make it bigger. For investors, founders who keep trying to go after funding again and again is a huge turnoff for investors, first of all, because they feel the business will start getting lesser and lesser attention right now. And also you have to always make sure that your pitches are always practiced perfect overall, and draft a pitch deck right now. And that's, I think, it's just like a racing around thing, that's it. So it is just, all these things are again like just the in detail things of what I have mentioned. You can just you can just make a list of, again I'm talking about people who have never interacted with any investors. You can just make a list of 100 investors, start sending them messages, see if they are really, see, as I mentioned, if you are a biotech company, maybe a SaaS focused investor might not be the best bet. first of all. So it is always better that you just do your preliminary research and then try talking to these investors, first of all. And these investors might even help you connect with other investors, so which is a good thing. And one thing I can definitely say talking to these investors till date is these investors are very, very helpful. They always want to help a startup. So they will always take effort for you to connect, making a connection with the other investors as well, or other founders as well. And as I mentioned, you basically have to go out, talk to these people, and always you should be mentioning what is your target segment, how you basically started, what is the kind of traction you are able to build till now. And also you can also ask them for suggestion, because these startup investors, there are people who have founded companies as well. So they will be able to share their experience in terms of how they built a company, what worked, what didn't work, and all. This is a very, very crucial learning that you can get from these people. And as I mentioned, if you basically, it's a very small community. If you are able to mess up with, if you are able to, like, if you end up messing with someone, word spreads very, very fast, and it becomes a very bad negative vibe. To always having a bad relationship with an investor, it always becomes a negative vibe. And pitches, one more thing I want to mention here is pitches are not built like in one day. A pitch deck or pitches are basically built throughout, like, all the days that you have worked on the company, right? Because you're talking about the story in terms of what made the company tick, what will make the company scalable. Now these information, you can put together the data, but the point is you should be able to put it in a sensible manner which will make sense to the investor, and which will be able to tell them saying this is the story of the company which will be able to scale up to 100x of whatever it is right now. Is again, as I mentioned, is, see, this is just like a in-depth of whatever I have mentioned till now. So with fundraising as a high priority, ensure that you have a couple of partners to help with you manage the communication. And also, whenever you have investment bankers on your payroll, they actually help you a lot. Whenever people come to pre-series A, series A level fundraising, they always try to hire an investment banker who will help them to do the fundraising, manage that entire fundraising aspects and everything, and they take care of the entire thing then. And also, as I mentioned, whenever you look at these aspects, right? So you always try to see if you are able to sell the metrics or the vision. And as I mentioned, if you talk about the previous thing, right? As I was talking about the Zepto thing, we are talking about the Khata book thing. You can notice that these companies were trying to focus on the high amount of usage of frequency. Now here you can talk about saying that of a vision. For example, you can say that every Indian will start using phone pay someday, and that point of time, even if we charge a 1 rupee or 2 rupees extra, they do not mind, because they know that we are very, very helpful for them, and we are providing that level of convenience for them, and we are not charging very heavy amount, we are just charging smaller amounts that way. That's the kind of things you can say. And pre-qualify your investor, try to take feedback from other people who have taken investment from the that specific investor. Ask them like what kind of expectations do these investors have from that specific startup, what worked, what didn't work. And this type of due diligence always works when you know that the startup, the investor is interested in you and is interested in funding you. Then you can always do this due diligence. And as I mentioned, what happens is lot of CEOs basically get excited with the fundraising thing, and they stay on it on and on and on. And whenever they stay on and on it, the business takes a pushback. So you should have enough systems in place where the systems can run on their own. And once the fundraise is back, you can again come back and see if the systems are working as it is, and you have to enhance them, or else you have to repair them. You have to make them better or not, that way. And you have to always make sure that before going to any sort of invest, you have to like really take feedback from multiple people in terms of whether the right point is being conveyed or not. Because I have seen people who have basically like run their pitch deck through some 10 to 20 people to see if the pitch deck was sounding right or pitch deck is interesting or not, that way. And they have received several suggestions from each of them, and they were able to incorporate them. And what should the pitch deck really have? The problem, the solution, traction is one key thing that people are prioritizing right now. And customer insights. So customer insights becomes very clear, because someone was asking right about the service business. Now, for example, if you are providing the service of maybe fan clean servicing of ACs, now you might say that servicing of ACs is a very important work that will be happening maybe in the winter, that is just before summer, something like that. Now you might do heavy amount of marketing in winter, let's assume, which is very counterintuitive. I'm just giving you as a very rough example this one right now. But let's assume you have noticed that people start looking at AC repairs at least 2 months before summer, which is like almost like winterish type, something on those lines. Now, if you are doing marketing at that point of time, then you know that you have known something that no one else in the market is very much aware of, and you're already collecting your customers that way. So having a very right customer insights always helps to capture the market faster, and it will always act in your favor. And this GTM is nothing but go-to-market strategy. So the go-to-market strategy was actually structured based on the customer insights, first of all. And the business model, will I be charging a subscription? Will I be charging how much will I be charging based on my service, or how is it? And the competition, how aggressive is the competition? How is the competition working out? And the team, and how much are you trying to fundraise? What is it that you want to fundraise? What is it that you want to utilize it for? So all these things I want to understand, because you have to have a very great clarity on what you want to utilize this fund for, and what is the kind of growth that you want to achieve with this fund. Only then the investors will have a clarity on, okay, this guy is having clarity on what is he or she is asking. So that makes sense. That is the reason why they are asking so much of amount, first of all. And talking about few cases that I was involved in personally. So there was this Bangalore-based drone-based company which has had like 3 to 4 patents. So they had a strategic investor, which is a very big, huge corporation, publicly listed company, that was basically that already invested some 1.5 crore in them, and they really set the valuation over there, and then we funded some more money over there. And there is one more AI speech tech company which all and just to come back to the previous example, so the drone based company did not have any customer. They only had a order book, and they only had one to two purchase orders, and they already were pre-product, where the product is not launched but under the experimentation phase. But still the founders were very drenched in terms of the drone technology. I knew the founders personally for the last 4 years, where they have been very well versed with the drone technology overall. So that gave the confidence, saying that okay, this founder is good to go, this founder is the right person to bet on, so let's go ahead and bet on this founder. Now coming to Bangalore-based speech tech company. So Bangalore-based speech tech company, they did a $1 million pre-series A fundraise. They already had business, they already had good amount of 40-50 people working with them. Now they wanted to do a pre-series A of $1 million to basically grow to maybe like 100-member team, where they could increase the revenue by 2 to 3 times, and then do a series A again to grow even more aggressively. And very similar story with the AI facial recognition company, which did again a pre-series A of $1 million, where they already had a 15 crore revenue coming in already. So they just wanted to grow more aggressively. They wanted to do a pre-series A of $1 million and then go to the series A. So all these things are like a couple of examples which I basically just did on. And as I mentioned, so there are several instruments how you can do, where equity is more like a price-based round, where the shares are fixed. CCPS again is a very similar thing, but where what you do is you basically have again like some sort of, because where you are investing in CCPS very early, and also CCD is something like it's more like a debenture, where your debt gets converted into equity. And safe round is something that you do it in a very early stage. So these are all very valuation required thing, where you can read about it more, because I feel this is a bit too short of a session to discuss about these things in specific. But as I mentioned, it is always best to have someone else do the valuation for you rather than you doing it yourself, because it always will give a concrete idea to the investors as well.
Thanks, Vamsi. We were just signing off, just taking a participant count and everything else. Thank you so much for doing this with us. And we'll get in touch with you for the startups.
Sure, definitely. Thank you.
Thanks for your time yet again. Thank you so much. Thank you all for joining for this masterclass. We look forward to sharing this as well as details on our next masterclass. Thank you. Have a nice day.